In 3, 2, 1, go. All right. Welcome back. Now in this second part of the margin leverage session, we're going to go through some live examples of how margin works and how leverage works in your account. Not just for if you have a US dollar-based account, but let's say if you have an account, we'll go with our Australia example, since I do know there's a lot of students that come to me from Australia. So we'll go through. We'll try to. I don't know if any of you have ever traded Forex before, but we will hand calculate our margin in this session, and I'll show you that yes, we do. We didn't just stay at a Holiday Inn Express last night. We do in fact know what we're doing here at NurreFX. So we'll go through some margin examples. So remember, as far as margin goes, it's 2% of your base currency exchange rate to the account currency. So I'm in US dollars times the lot size. So let's switch over here into our MetaTrader platform. And here, since we have dealt so much with the Euro US dollar, we'll go in and we will do a single lot. In this case, we will put in a new order. We'll do one standard lot. And we will buy, we'll just go in and buy the euro dollar. I'm not trying to make a bet on direction here. I'm just doing the trade. So let's buy it. So we bought the one standard lot of USD at 1.11001. So we have that executed. So let's go ahead and write that. In this case, we bought one standard lot EUR/USD at 1.11001. What is our margin requirement using, in this case, 50-to-1 leverage? So at 50% leverage, which is my maximum here in the US, I have to put up essentially the equivalent on one standard lot. I have to put up the equivalent of 100,000 euros. So that's where I really have to put up. However, I have to put up enough US dollars in those euros, if that makes sense. So in this case, on the Euro USD, the exchange rate of how many dollars it takes to exchange for a euro is 1.11001. So it'd be 2% of 1.11001. I do that on my trusty calculator. 1.11001 times, and that comes to 0.0222. Oops, 0.0222002. Now, since I traded a standard lot here, I take that number and I multiply it by 100,000, which is my lot size, and that's going to come to $2,220.02. Now, I haven't looked at our account balances yet, but this is what we call minimum margin requirement. So let's take a look at how this affects our account. I'll go ahead and take this off. Go to View Terminal. And here we go. Here's our buy of Euro USD at 1.11001. Now when I pull up the account information, the margin requirement should be exact to the penny of what we just calculated. See that? There's our margin requirement, 2,220.02. And let's take a look. Margin $2,220.02. So that came out exactly to our calculation. In this case, you're going to see a couple of different numbers here. You're going to see a balance number, an equity number, and we'll go ahead and we'll pull up we'll put our worksheet up in here. And where this puts us is what's called our balance number. This is on the MetaTrader 4 platform. Our equity number, our margin number, and our free margin number. We'll just calculate we'll just use all of those as an example. What does your balance mean? Your balance is your cash balance excluding open trades. So before we put this trade on, our balance in our account was $11,593. Our equity number is essentially your cash balance plus or minus what we call open P&L, profit and loss. Which in this case, if you took, right now we're at 0 on the trade, we're down $1. So you can see that equity number, the balance number is not changing, but that equity number is. Because what it's doing is it's taking that cash balance and it's subtracting our total profit and loss from that number. So in this case, if we're down, let's say $25, we're at $11,561. So you can see it's $11,593 minus, now it's $36. So it's a little bit harder to calculate that one on here. Your margin number, that's the minimum amount. See this equity number as it fluctuates up and down. This is the minimum amount of equity we have to maintain in our account. And the free margin is essentially equity minus margin equals free margin. That free margin number down here of 9,329, that's how much we could put on, that's how much more we could put on with different trades. If we wanted to put in other positions, that's the amount of equity, that's the amount of margin we have left over to put on other trades. If we didn't put a stop order or manage our risk, that's the maximum amount this euro US dollar pair could go against us. So that free margin number is always going to fluctuate. The cash balance is definitely not going to fluctuate. These numbers right down in here is what you have to keep an eye out for. Now, as you can see, if we were to go in and over leverage our account, let's say we were to go in and we're going to gradually run out of equity if we were to go in and over leverage our account. Let's say we were to do 3 more standard lots on this euro US dollar. Now look what happens. Our margin is now, those 3 numbers are changing now. Our equity is still going up and down. Our minimum margin requirement now is down to 8,870. Our minimum margin requirement is now up to 8,879. And our free margin is slowly going away. If this free margin number ever goes to 0, that's what would trigger a margin call. And where most people can get into trouble is if let's say we were to do another lot on here, you see how it's going red now. That's because we are slowly dwindling away on our margin requirements. We have 5 standard lots on, we're controlling 500,000 euros in this case. And we're slowly but surely running out of free margin. So if this euro dollar were to continue going down against us on 5 lots, if it goes down against us by, what would it be, 8 pips, we would be in what we call a margin call. And this will generally turn red once you get within a certain percentage. In this case, we're within 10 pips. If you get within 10 pips on the MetaTrader 4 platform of a margin call, that's when you'll see those numbers go red. And that generally will come from most traders over leveraging their account. Let's go ahead and clear out some of those trades. Get back to where we were There we go. Now on the flip side of this, you may ask, let's go to another pair. Let's go to dollar yen on this. Remember this example from up here. So let's go in and just kind of slide some of these things over. Let's do another example in a US based account. Here we go. Let's go ahead and buy 1 lot of the dollar yen. We'll do 1 standard lot. Actually, we'll do a mini lot. We'll do 0.10. And let's buy one lot of the dollar yen. So I'll go ahead and buy by market. Now what's going to change here, we can go ahead and calculate. We got in at 113.787. So we bought one mini lot dollar yen at 113.787. In this case, we have to put up 2% of the base currency's exchange rate to the account currency. Well, what's the base currency? The base currency is US dollars, right? So we can skip that step. As far as the margin requirement goes, we're putting up 2% of dollars. We have dollars in our account, so we don't have to worry about the exchange rate. So we're just putting up 2% of 10,000 US dollars, which is going to come to $200. I forgot I put in another odd lot in there at one point. So that would come to $200. I have one right up above that. I doubled up on 0.01. So we don't have to put up as much. In this case, some brokers, I believe in this case, the smaller amount on lot size you go, I didn't put in an odd lot. In this MT4 platform, I think on forex.com, they had put up a 3%. They increased their 3% to a 3% margin requirement on the dollar yen pair. So we actually had to put up 3%. So they decreased the leverage on some of the pairs here. I knew they did it to dollar Swiss after they unfixed the exchange rate, but I did not know that they did it on the dollar yen pair. My fault. So in this case, margin requirement is 3%. Maybe a bit confusing to you, but brokers, depending on underlying volatility for a currency pair, can often change their margin requirements. So this is actually a very good lesson on this, is that, for example, when the Swiss unfixed their exchange rate from the euro, they increased their margin requirements on the dollar Swiss pair, to where it was no longer 50 to 1 leverage. They had lowered it down to, I believe, 30 to 1 leverage, and on the dollar yen, I believe they lowered it to 31 leverage also, based on some underlying volatility at that time. So in this case, dollar yen requires a 3% margin requirement through this individual broker, which I did not know before we placed that trade, that they had done that in this particular demo account. That's how it's working. How do we figure out what the actual margin requirements are? When you pull up your your listing on your Market Watch, you can go down here to specification. And under specifications, they'll generally tell you where your margin percentage was. So 150%. 150% when it comes to margin percentage is generally, instead of 200%, which would be 2 to 1, they're lowering it down to 150%. So that means that it's going to be a 3 to 1, 3% margin requirement. So in these typical calculations, that's where those margin calculations are going to be told. Like if you go to euro dollar to specifications, you see the margin percentage is at 100%, and they're generally basing that on your account size. My account size is 50 to 1 leverage. That's where I have it set at. So my margin percentage is at 100% of my individual margin requirement, which is 50 to 1. On the dollar yen, it's 150%, so I have to put up a little bit more, 3% in fact, for my margin requirement. Depending on where you live, this can also change. This is for a US dollar based account. If you were to live in, let's say, let's go through an Australian example. And I believe in Australia, you have leverage available to you of 100 to 1, which would be a 1% margin requirement. So let's say you were to buy one standard lot of, let's see where the Euro Aussie pair is, of Euro Aussie at 1.48078. Now, I don't have an actual Australian account, so we'll just have to go off of this. So in this case, we'd have to put up 1% because we have access to higher amounts of leverage, 1%. So we had to put up 100,000 euros essentially, and we can already see how many Aussies it takes to exchange into a euro. So 1.48078, which would come to .0148078, and then we would take that number and multiply it by lot size. So you'd have to put up 1480.78 Aussie dollars minimum margin requirement, and everything else would work roughly the same way. But one thing to remember is this is the amount that we have to put up in order to hold the position. It's the minimum amount of equity we have to put up in order to hold the position. What does this mean to you really when it comes to risk? Well, you know, we never want to be being put in a position where our margin requirements tell us something about our risk. Our risk is actually based on how many pips we want to risk on a trade and knowing our pip values and whatnot. This is just the amount that we have that's put on hold in our account to carry a position. It tells us what our maximum risk is based on movement in the underlying FX market. It doesn't take into account gaps that can happen over the weekend or during certain news announcements. It's just telling us if everything remains liquid in the market and there's no openings and closings of what our maximum risk is in our account, assuming that things do not occur that can create more volatility. And remember, your individual Forex brokers, when you're trading in spot FX, kind of like we saw with that example on dollar yen, can actually raise and lower margin requirements based on underlying market conditions. For example, if I have my account set at 50-1, like we did on these specifications, my account is set at 50-1 leverage. The margin percentage telling me that I can use 100% of my 50-1 leverage. When it's set 150% here on this dollar yen, if I have my account set at 50-1 leverage, that means I have to put up 1.5% of my leverage amount, of my margin calculations, if you will. So that's where it can change from broker to broker. So there are some live examples of margin. Next up, what we're going to be getting into is trading basics as far as our next subject matter of buying and selling, how to put in stop orders, how to put in limit orders, and actually buy and sell, going long and short in the Forex market. You're not always buying low and selling high. It doesn't have to be in that order. Sometimes you sell high first and you want to buy back at a lower price. So that'll be our next lesson. So I will see you in our next tutorial.